There are 8 huge mistakes that you could be making with your management accounts that could turn a simple audit into a waking nightmare when you come to sell. Hi, I'm Dan Bradbury. I made my first 7-figure exit whilst in my 20s, and since then I've bought, sold or merged over a dozen different companies. And I've also looked at a lot of management accounts. If you're not clear about what makes a good set of management accounts, check out my last video here. The first of the 8 big mistakes you could be making is incorrect data. The number of times I look at a set of accounts and immediately it's obvious there's a mistake that's been made. And if your potential buyer looks at that, it's going to cause them to dig deeper and deeper, and it undermines all credibility and your chances of making the sale. And another example is if there's mistakes, the tax man, it gets flagged up to them. They do an investigation and then they can call it back and they can go back for multiple years and rack up a big past tax liability that you have to pay. Second big mistake is only looking at individual statements for one time period, one financial year, for example. It means nothing without context. Is 100,000 in profit good or bad? It depends. How is it trending? Is the company trending upwards, down, or flat? And you only get to see that if you see multiple time periods on the same page side by side. Number 3, using overly round numbers. Look, practically, sometimes provisions are made or estimates are made, but a nicely rounded number, rounding to £1,000 or £10,000 or whatever, with just zeros at the end, is a flag to somebody that there's an estimate here. In other words, it just sows a seed of doubt about whether or not it's accurate, and that once again it undermines the credibility or the trust that they have in you. Number 4, not breaking out your BOB, that's business owner benefits, separately on the P&L. So in other words, most business owners take advantage of tax breaks by paying for items that benefit them personally through the business. Nobody's suggesting anything illegal or shady here. There's legitimate tax breaks. I think you should take advantage of them, because if you can buy stuff with pre-tax income, it's clearly better for you than paying for it with post-income tax income. However, mixing your personal expenses with some essential operating expenses muddies the water, and it makes it difficult for a potential buyer to assess what is the true underlying profit of the business, and it is going to weaken your valuation. As a side point, this business owner benefit being broken out is often referred to as adjusted EBITDA or adjusted profit, which is basically meaning whatever the profit that was shown to the taxman, they then add back the business owner benefit, and that gets you to the adjusted profit figure, which the business valuation is based upon. So you need to make life much easier for yourself by just separating it all out from the start nice and clearly. Number 5, not provisioning the tax. Just because you haven't filed a VAT return or you're not at your financial year end yet doesn't mean that you do not owe the tax. You do, it's just not been filed. And if you haven't got a provision in for that tax that you estimate from the year to date, it means that your accounts are overstated. Another way of saying that is that they are wrong. And if the provision is missing and there's under estimate on the taxes owed, it will overvalue business. And ultimately, this is going to come out in the due diligence process anyway when you come to exit. And doing so will put you on the back foot and severely weaken your negotiating power. Mistake number 6 is assets or liabilities being shown on your balance sheet as a negative number. So negative assets or negative liabilities. Here's an example. Most commonly seen with directors' loan accounts. If you've got a negative asset, it's actually a liability, but it's often listed incorrectly in the asset section as a negative number. Director's loan account minus £10,000. Well, what that means is that there is a liability to the director for £10,000. So put it in the right place from the start to avoid the buyer having to do the mental gymnastics to figure out what's going on. If you can't understand it and explain it clearly, there is no chance that your buyer is going to be able to. Mistake number 7, not updating your balance sheet. A great example of this is stock being left at the same value. So in other words, if I see the last 6 months of balance sheet side by side, and I see the value for the stock in the balance sheet is £67,345 every month for the last 6 months in a row, I know that's highly unlikely that there's been no movement in stock, which tells me it's most probably wrong. And once again, you've undermined your credibility across all your accounts just because you haven't updated that one line item correctly. And finally, mistake number 8 is not updating your management accounts regularly enough. The purpose of management accounts is to allow management, i.e. you, to make better financial, ultimately business decisions. And if you've got old or late management accounts, you've got no idea what's going on. I think you want management accounts monthly within 10 days following the month end. I mean, it depends on the context of your purpose. So if somebody's buying a business, they're going to want to see years side by side going back for several years. I think from a management point of view, you want to be looking at them at least quarterly. But if you really want to be dialed in, monthly management accounts are a must. In fact, I've yet to find a business that's growing fast, successfully, sustainably over time who is not paying attention to their management accounts on a monthly basis. If you're liking these videos, you're going to love what's coming up next. It's a tale of fraud. It's how a client of mine went from having a multi-7-figure exit on the table to being defrauded out of almost £2 million. So make sure you like and subscribe so you don't miss out. And this is part of a series of videos about how to sell your business. So look back for the previous videos about valuing your business, about preparing management accounts, and stay tuned for more.